Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by. Hey, thanks for joining me again. Today I'm going to be looking at how well Gemini 2.5 can do as far as selecting assets for us. This is hello. Can you please generate 5 different stock and bond portfolios that historically have had a higher Sharpe ratio than the S&P 500 from May 2020 to April 2025? And that was the most recent modern portfolio theory model that I'd put out, and so same date. So I knew a lot about that data series. And it says, unfortunately, I can't do that. I would need to get the, a detailed historical simulation and return calculations for various portfolio compositions. I mean, it is a big task to ask it to consider, what are there, like thousands, tens of thousands? There's got to be probably hundreds of thousands of assets. So without any more guidance, is it really going to sit there and calculate on a free version all the returns? And Sharpe ratio is like a risk-return trade-off that we boil down into a single number. So, a good Sharpe ratio would be above 1.5. 2 would be really great. But what we found was like 0.83, and we saw S&P 500 was coming in around somewhere between like 0.45 and 0.55. So, it's a lot to ask it to do. So this would require access to precise monthly return data for all chosen assets in a robust computational environment, which is beyond my current capabilities as an AI. So I said, okay, well, one of the things, I don't know if they're intentionally dumbing these down or if they have some agreement with the financial services industry, right? But you can imagine that they're going to put some limitations on this. Otherwise, they're just going to, if you can just type in, hey, make me the best portfolio, please. You're going to get rid of a lot of financial advisors, Dave Ramsey types and all that stuff, if it was just that simple. But obviously, you're not going to get that on a free version. So I was like, okay. Also, if you pay for Pro, I don't know how much Pro is. I think it's $20 a month. It will generate for you an Excel sheet with adjusted close prices, but it won't do that on the free version. So anyways, you need to give it the data, and you need to pick the assets, which is right. That's what 99% of the whole work is like. What assets should I pick? There's 100,000, 500,000 of those things. Says, however, I can explain the concept of Sharpe ratio and why we talk about risk-adjusted returns. So the formula, just if you're not familiar with it, it's the return on the portfolio. So let's just say that's 12% minus a risk-free rate. Let's just say that's 3%. So that's 12 minus 3 is 9, and then divided by the standard deviation of the portfolio. Okay, and it just as it says here. So it's like 12 minus 3 is 9% divided by standard deviation, which is also stated as a percent. The percents cancel, and you basically end up with a number. 1.5, 2.5, 0.75, something like that. And basically, you want it to be as high as possible. So it'll talk you through all that, and it can explain the classic 60-40 portfolio and all that stuff. So it's like, great. I said, well, what if I gave you the stock prices of 100 assets? Could you do it then? And it said basically, long answer, yes, it could. You'd have to clean the data, and you need to calculate the monthly returns. You need to define all this stuff and come up with a return for the entire portfolio. And then it could calculate the Sharpe ratio. So in summary, yes, with specific historical price data, I could do it. So I said, okay, I had the data. So I said, okay, here's the data. Here's a file. It has what you need, dates, monthly data. So it says, okay, look, we have all these assets. And so I confirmed that, it had what it needed. And so I said, first and foremost, I want to know, can you outperform the S&P 500? So I calculated a Sharpe ratio for the S&P 500, 0.2331. And it was calculated, this and that. And this is the short-term rate that it used and all that stuff. Like, okay, great. So I said, basically do whatever you want, pick any assets, pick any weights, and come up with a portfolio that has a higher Sharpe ratio. Just make it it could be 2 assets or more than 2 assets. And it basically said, well, here's some. Let's do 60-40. It says, but that has a lower Sharpe ratio. Here's another one, lower Sharpe ratio, lower Sharpe ratio. So it's like, well, it said it basically couldn't find one. So then I basically gave it the ones from the modern portfolio theory, the assets and the necessary weights. And it said, oh, what do you know? Here's a portfolio that has a better Sharpe ratio than the S&P 500 by a lot, 0.38 compared to 0.23. So significantly better. I said, okay, try it again. We need a Sharpe ratio better than 0.2331. And it was like, oh yeah, I already found one. Like, yeah, I appreciate that. Like, I gave you the answer. So so then it basically came up with a lower quality Sharpe ratio portfolio that was better than the S&P 500, but not as good as the one that I gave it. And I said, hey, look what I did. So far, like, I'm not that impressed. And so I said, okay, well, now that you kind of get the idea, I gave you basically the general assets that are superior than the ones you want to use. Can you find, given what I've given you, better than what I gave you? And it was like, no, I can't. So it said, like, if they put 50% in SHY, 40% in gold, and 10% in Bitcoin, you could come up with a Sharpe ratio of 0.31, but it's still lower than 0.38. So what I'm basically seeing is, like, I'm probably going to keep running. I mean, I'm definitely going to keep running modern portfolio theory. And it looks like, as far as my friend, as much as, we like to help people in the community, I was just thinking, well, we're going to ask people to pay for, well, this is free, but see, it's not going to be able to help people very much, right? Because it can't really do the calculations. Now, I asked him to run it in Pro, and we'll see what he came up with, or you can try it if you have Pro or some other model. So then I basically said, okay, like, give me the Sharpe ratio for all the assets that I gave you. So this is the same one I put on the website, and I talk about these all the time. They are just assets from the basically 11 U.S. equity sectors, plus a couple extras: gold, Bitcoin, Vanguard's VTI, all equity, U.S. all equity fund, junk bond, corporate. I can never say that. Corporate junk bond fund, corporate investment grade fund, and emerging markets without China. And so it is able to basically, I think the best it can do is really give us Sharpe ratios for like all of these, but it still doesn't tell you which ones to invest in. And it still can't really, unless you already know the answer, it can't really, like, come up with something better than the S&P 500 unless you like just provide it for it. So, I mean, it got this part right, and so you could just tell people maybe buy some random assortment of maybe the top 10, but you still wouldn't know what weights to invest in. Weights, we mean, like, how much money do you want to put in each of these assets? It ends up that the average Sharpe ratio for this list is 0.16. And then I asked some questions about how it's calculating the return and these things. So I just thought, well, that's sort of interesting, I guess, as far as with my friend. I mean, we sort of talked, and we were like, well, in the Christian community, there's this guy named Dave Ramsey, and he pretty much has a monopoly on the market as far as, like, Christian wealth advisors that I know of. Definitely, we're interested in helping anybody, but some of the thinkings that we'd had would be, yeah, I mean, it would be like a religious base, like if it was a Christian ministry or something like that. And so we were just thinking, well, I mean, you could start a DIA. It's like it's basically a firm where you can be an independent advisor. And then would I want to run this? If we don't do that, we run into all these regulatory problems, like you can't give financial advice. We're kind of like toying with this idea. Is there some gray area where you can give basically people some financial education and then tell them to, like, take these ideas and open up their AI and basically come up with something pretty good? And I would say no. Let me punch around here a little bit more. Okay, so let's try this. I asked it, I said, look, we know the best assets according to their Sharpe ratio. Use the 7 assets with the highest Sharpe ratio. Can you make me a portfolio that has an expected 12% return? So it lists the 7 and it gives the annualized return. Okay, so what it gave me was it basically said it cannot give me a 12% annualized expected return portfolio. It's basically the current capabilities does not include this advanced optimization functionality. So that's what we teach in the Modern Portfolio Theory course, and that's what we're using on those Excel files that we put on Patreon. So what does it say? It says, well, we could do an equally weighted portfolio. And if it did that, it looks like it would have a 21.9% expected return. So then it would basically say, instead of doing equally weighted, basically put more money in the ones that have the lower returns. That's its answer. So I guess you could get sort of close. It's probably good enough for people that are investing like $10,000, maybe $20,000. Maybe they're not really, sure what they're not planning on being like long-term stock and bond market investors. Maybe that could be okay. I guess it doesn't feel like that's enough to... I think it's probably good enough for maybe a lot of people, better than just guessing or having like this random assortment of assets. So at least that's something. So now the question is like, if people can get that for free, what do you guys think? If you can get that for free, is it worth it to pay, what are we charging? $5 a month? So $60 a year. Is it worth it to pay $60 a year to learn how to do modern portfolio theory? Or, is it enough if, you were in a program where you want to get your money, financial health and strength going, as well as workout and, eating and all this stuff? Would it be enough just to say, okay, in the financial health model, like we'll be talking about how to increase your income, which I think is the biggest portion for most people. And then if you have people that are kicking off a lot of extra income every month that they don't need, and we could convince them that, hey, the 2% or 2.5% fee is going to just destroy you if you stick with an advisor for 30 years, figure out how to do it yourself. And we would suggest a free option would be, I guess just use these assets and follow these instructions. You can do it for free. I mean, we could just print this off, I suppose, and just give it to people. I don't know if that's a ministry. I don't know if that's worth making a nonprofit for. Because my friend and his wife, they're already doing a lot of the... they have like a health clinic, healthy eating, chronic disease management, and stuff like this. So they were thinking, man, there's multiple aspects. There's a spiritual life aspect, there's a physical health aspect, there's a financial health aspect. And so they thought, what if we could, do something to build the financial piece in for people? I would appreciate any feedback from you all. I mean, there are a bajillion financial advisors already out there willing to take, 2.5% guaranteed money off of people, whether they, whether there's a 10% return, a 2.5% return, meaning that the customer doesn't even make any money, or if there's losses, then the advisor makes money and the client suffers the losses. But there's a million organizations out there that are willing to do that, and they seem fairly popular. We're talking a little bit more here about helping people learn something structured with their own, limited finance education to be able to lean on AI. I guess the question is, at what point does it become financial advice? I don't really know. You want to help people, but you don't want to get sued. So anyway, well, that's just, I thought, some interesting feedback from what AI can and can't do. And then if you sort of baby it, it will, and you really know what questions to ask, then it can kind of get you sort of close. But if you just ask it sort of matter of factly, hey, make me a good portfolio that's better than S&P 500, it can't do it. It doesn't know where to start. And if you sort of continue to feed it better and better info, then it can get you close. I think probably with these assets, I don't know what the risk profile would be on this. I mean, equally weighted in Bitcoin, you have financials, industrials. You are investing in the S&P 500. It's a Bitcoin, 2 financials, gold, junk bond, and industrials portfolio. I mean, that's it's something. It's something. It's not better than what we were able to come up with using modern portfolio theory, but I think I'll wrap it up there and would appreciate any feedback from people. Thank you.